I watched my business partner Daniel Ruth turn $10,000 into billions over 6 decades, 60 years. Not through luck, not through insider knowledge, not with any single brilliant stroke that the rest of us couldn't replicate. I watched him quietly, methodically compound wealth while so many intelligent, hardworking people, doctors, lawyers, engineers, executives, entrepreneurs, earned more money in a single year than we did in decades and ended up with almost nothing. They had talent, education, and drive. They worked harder than most people I knew. They made good choices in their careers. But they made one mistake that cost them everything. They didn't understand money. They didn't understand the patterns. They didn't understand how wealth flows from one pocket to another, and how time, patience, and compounding turn seemingly small decisions into life-altering outcomes. The difference wasn't intelligence, it wasn't work ethic, it was decisions. A handful of decisions repeated consistently over decades. One simple concept: where to put your money, and more importantly, where not to put it. I've seen this over and over in my 98 years. I've watched friends and colleagues pour their lives into investments they thought were safe, prudent, responsible. And every single time, the results were consistent. Their wealth eroded slowly, relentlessly, sometimes invisibly. Until decades later, they retired with far less than they imagined. The first wealth destroyer is something almost everyone considers prudent: whole life insurance, universal life, permanent life insurance of every variety. Salespeople promise safety, investment growth, tax advantages, cash value you can borrow against. And people buy it because it feels responsible. They're told, you need life insurance anyway. Why not invest at the same time? Here's the reality. Almost 50 to 100% of your first-year premiums vanish immediately into commissions. The agent pockets it. You think you're building wealth, but all you have is insurance coverage. Over decades, the growth in cash value is negligible. Compare that with term insurance and investing the difference in productive assets, stocks, businesses, index funds, and the results are staggering. One friend of mine paid $5,000 a year into a whole life policy for 30 years. His cash value at the end? $168,000. Had he invested the same difference in an index fund, averaging 10% returns, he would have had nearly $900,000. The math is simple. The lesson is clear. Insurance is for transferring risk. Investments are for building wealth. Never confuse the two. The second wealth destroyer is conventional real estate investing: rental properties, vacation homes, commercial buildings. The American dream says, buy property, leverage debt, collect rent, and retire wealthy. But the devil is in the math. Transaction costs, carrying costs, property taxes, maintenance, insurance, mortgage interest. These erode returns quickly. And if markets turn, leverage works both ways. A 20% decline doesn't mean you lose 20% of your equity. It can wipe you out entirely if you're highly leveraged. Meanwhile, Daniel Ruth quietly invested in productive businesses through stocks, companies that produced profits year after year. Over decades, the difference is monumental. People prefer tangible assets because they can touch them. Stocks are abstract. Businesses are invisible. And this illusion of control over a physical asset is a psychological trap more dangerous than most people realize. The third wealth destroyer is gold and other precious metals, safe, tangible, finite, hedge against inflation, hedge against catastrophe. It sounds good until you compare it with productive assets. Gold doesn't generate cash flow. It doesn't innovate. It doesn't compound. From 1975 to 2023, gold appreciated roughly 12 times. Stocks, with dividends reinvested, grew nearly 90 times. Gold is speculation wrapped in a historical narrative. It feels safe, but safety without growth is not wealth. It's a comfort blanket that quietly robs you of opportunity. The fourth destroyer is actively managed funds, hedge funds, private equity, any investment where someone else manages your money for a fee. Fees compound. Over 30, 40 years, a 1%, 2% fee annually destroys tens of millions in potential wealth. Studies show 95% of actively managed funds underperform their benchmark over decades. And yet people buy them because someone promises skill, expertise, and superior returns. The reality is simple. The manager gets rich, the investor underperforms. Compounding doesn't care about prestige or feelings. The fifth destroyer is cryptocurrency and digital assets. Speculative, unproductive, volatile. Bitcoin, Ethereum, countless altcoins, they produce nothing. They don't generate cash flow. They don't solve a productivity problem for society. Value exists only because someone else will pay more tomorrow. Every innovative coin is a greater fool trap. Daniel Ruth never touched cryptocurrency. He invested in businesses that produced real earnings. Over decades, the difference is staggering. The sixth destroyer is bonds. Safe, predictable, rational. At first glance, yes. But most bonds underperform inflation after taxes. They preserve nominal value but slowly erode purchasing power. People cling to bonds emotionally because volatility scares them, not because bonds are mathematically superior. Over decades, the safety they offer quietly impoverishes. The seventh destroyer is lifestyle inflation and consumption masquerading as investment. Luxury cars, status purchases, expensive vacations, depreciating assets disguised as symbols of success. The average new car costs $48,000. Finance it, pay interest, drive it off the lot, and it loses 20% immediately. The opportunity cost is even higher. That $48,000 invested at 10% returns compounds to over $120,000 in 10 years, $14,000 in 20, $15,000 in 30. People ignore this math for a fleeting sense of social status. But there are additional destroyers, subtler, more insidious. Eighth, ignoring compounding. People withdraw from accounts unnecessarily, make emotional decisions, try to time the market, and interrupt decades of growth. Daniel Ruth understood that consistency, even in boring investments, beats speculation. Ninth, taxes. People mismanage tax planning, pay unnecessary capital gains, and fail to use tax-advantaged accounts efficiently. Over decades, this quietly destroys wealth that could have been compounded. 10th, leverage in emotionally motivated decisions, mortgages, margin accounts, borrowing to chase trends. Leverage magnifies losses as much as gains. Many intelligent people watched their wealth evaporate in crashes because they misunderstood this principle. 11th, chasing trends, fads, or hot investments. .coms, NFTs, speculative tech bubbles. Daniel Ruth never chased hype. He studied fundamentals, earnings, cash flow, sustainable competitive advantage. Predictable growth over time compounds more reliably than excitement. 12th, Emotional decision-making. Fear and greed are the two most powerful forces in wealth destruction. People sell at market lows, buy at peaks, and ignore the mathematics in favor of emotion. Daniel Ruth observed this for decades, noting how even the smartest people succumbed to cognitive bias. I watched brilliant friends lose millions, retire stressed and dependent, all because they didn't understand patterns. Meanwhile, Daniel Ruth invested boringly. Stocks, productive businesses, low-cost index funds, disciplined savings, and patience. He avoided destructive investments. He ignored hype. He understood compounding. And over decades, the difference is staggering. I'm 98 years old. I've lived through depressions, recessions, inflation, deflation, wars, bubbles, panics, technological revolutions. One truth is constant. Wealth is created by avoiding destructive financial products, investing in productive assets, and letting compounding work for you over decades. The patterns never change. People lose money chasing safety, hype, and complexity. People build wealth quietly, methodically, and patiently. The secret isn't luck. It isn't genius. It's decisions repeated consistently, thinking in decades, not quarters, avoiding temptation, resisting social pressure, and focusing on fundamentals. That is the path to financial freedom. That is the path Daniel Ruth followed. That is the path anyone can follow if they understand the mathematics and psychology of money. There is another subtle truth I've learned over 98 years. Most people never actually understand what wealth really is. They confuse income with wealth, thinking that a high salary, big bonuses, or a flashy lifestyle equates to being rich. I've seen doctors earning $500,000 per year retire with less than someone making $60,000 who followed simple compounding rules and avoided the traps I've outlined. The difference isn't luck, education, or intelligence. It's how they manage what they earn. Money has two roles. First, it is a tool. Second, it is a mirror. It reflects your choices. It magnifies your mistakes and rewards your discipline. Daniel Ruth understood this from early on. He treated money as a mirror. Every decision, every dollar invested or wasted, told him a story about human behavior, market forces, and compounding mathematics. He observed patterns, repetition, human psychology. And then he designed his life around avoiding the predictable mistakes everyone else makes. There's another category I call financial inertia. Many people simply follow the defaults. They buy what financial advisors tell them, invest in what their parents did, rely on conventional wisdom, and never question anything. Over decades, this is fatal. Small fees, hidden costs, subpar returns, misguided advice, all quietly accumulate, silently draining wealth. People are convinced they're making smart choices because someone in a suit told them it was prudent. But the mathematics never lies. Compound interest is unbiased. It rewards correct decisions and punishes poor ones without mercy. I've watched friends and colleagues fall into this trap repeatedly. One man, a brilliant engineer, started working in the late 1970s, following the advice of his father and his financial advisor. He invested in a mix of actively managed mutual funds, bought gold because it protects against collapse, held bonds for safety, and owned rental properties in high-growth urban areas. Every choice seemed reasonable at the time. Every choice seemed rational. Yet 30 years later, when he retired, he had less wealth than a friend who had done the simplest thing, invested consistently in productive assets, and ignored advice that added fees, risk, or complexity. That is the power of compounding mistakes. One small misstep, repeated, becomes catastrophic. One consistent principle, repeated, becomes unstoppable. Let me tell you about something I call the illusion of control. People often overestimate their ability to predict markets, pick stocks, or time their investments. Real estate is a perfect example. Investors think they can control risk by choosing the right property, timing purchases, and leveraging debt. But leverage is a double-edged sword. A small market downturn can wipe out decades of equity. Tenants can default, neighborhoods can decline, and repairs can spiral out of control. Meanwhile, the stock market, abstract and intangible, compounds quietly, predictably, and relentlessly over decades. Daniel Ruth never needed to knock on doors or repair a leaky roof to grow wealth. His control came from understanding businesses, evaluating earnings, and holding them over decades. The stock market is impersonal, unbiased, and efficient. The irony is that most people fear the stock market's volatility, while spending decades worrying about property risks they can't fully control. There is a psychological cost to every financial decision, and people rarely account for it. Gold buyers worry constantly about collapse. Cryptocurrency enthusiasts experience extreme emotional swings with every market fluctuation. Real estate investors live with the stress of tenants, repairs, and leveraged mortgages. Insurance policyholders obsess over losing if they lapse, trapped by the sunk cost fallacy. Daniel Ruth avoided these distractions. He understood that emotional calm and focus compound just as reliably as capital. A rational mind invested consistently over decades beats a panicked investor every time. There's one more point I must emphasize: the power of delayed gratification. Most people seek validation now. Cars, vacations, houses, jewelry, gadgets. Every unnecessary expenditure reduces the compounding potential of their wealth. Daniel Ruth lived a life of deliberate simplicity, not because he lacked means, but because he understood that every dollar saved and invested decades earlier would grow far larger than any fleeting pleasure today. Compound interest is ruthless. It doesn't reward indulgence or distraction. Wealth is created slowly, invisibly, quietly, over decades. Patience is the ultimate financial advantage. And yet, despite all these lessons, the hardest wealth destroyer to avoid is society itself. Culture glorifies spending, consumption, and visible success. It teaches that wealth is shown in cars, homes, and status symbols. Daniel Ruth ignored these signals. He focused on invisible wealth, businesses, equities, and productive investments. The world rewarded him for ignoring convention, resisting social pressure, and thinking in decades. Here's another subtle lesson I've learned over 98 years. The most dangerous decisions often appear to be the safest. Bonds, whole life insurance, gold, and real estate all sound safe. They are endorsed by advisors, recommended by society, and marketed as prudent. Yet over decades, they quietly erode wealth, either through fees, opportunity costs, or psychological traps. The truly safe choice, paradoxically, is to invest in productive assets that grow earnings, compound dividends, and scale over time. Safety is not what feels comfortable. Safety is what grows purchasing power. I also observed a phenomenon I call success bias in perception. People see others who took risks, bought property, invested in speculative assets, and assume it works. But they don't see the hundreds of failures behind the success story. A friend bought a condominium in the 1980s and sold for a nice profit. Everyone admired him. What nobody considered was the 20 other investors who lost everything on the same block or in the same market cycle. Anecdotes are seductive. Mathematics is objective. Daniel Ruth always chose mathematics. Let's expand on the importance of understanding money as a system, not a single transaction. Most people evaluate an investment in isolation. This stock returned 10% last year, or this property appreciates 5% annually. But wealth creation isn't about single transactions. It's about patterns, compounded over decades, adjusted for fees, taxes, inflation, and opportunity cost. It's about minimizing invisible drains, like commissions, insurance costs, interest, maintenance, and emotional errors. When you calculate all of this across decades, the difference between poor choices and optimal choices becomes enormous, truly life-altering. Daniel Ruth also recognized the value of learning and adaptation. Markets, economies, and technology change. He didn't blindly repeat past actions. He observed, learned, and adapted. For example, when index funds became available, he shifted from actively managed mutual funds to low-cost index funds. Understanding that compounding minus fees always wins over speculation. When he saw new asset classes like cryptocurrency emerge, he studied them, evaluated risk versus productivity, and concluded they were speculative, not investment. Most people simply follow hype. Hype destroys wealth. Discipline builds it. Finally, let me emphasize legacy thinking. True wealth is not only about survival or comfort, it's about generational compounding. Every poor financial choice affects not only you, but your children and grandchildren. Whole life insurance, mismanaged real estate, speculative assets. They don't just fail to grow wealth, they destroy it across generations. Daniel Ruth didn't just think about his life. He thought about the ripple effects of every decision, every dollar invested, every asset acquired. That is the secret most people ignore. Wealth multiplies exponentially when thinking beyond oneself, and erodes exponentially when thinking short-term. At 98, Daniel Ruth can look back over decades and identify a pattern that repeats endlessly. Wealth is created quietly, with patience, discipline, and an understanding of mathematics, psychology, and human behavior. It is destroyed loudly through hype, complexity, fees, emotion, and social pressure. Avoid the 7 or 12 wealth destroyers. Ignore the crowd. Focus on productive assets. Let time do its work. Compounding is undefeated, immutable, and indifferent. Every dollar invested wisely decades ago is worth exponentially more today. Every dollar wasted, misallocated, or trapped in a wealth destroyer is lost forever. That simple principle explains why some people retire with billions and others, despite decades of hard work, have almost nothing. The choice at the end of the day is ours, and it is the same choice Daniel Ruth made over 98 years. Discipline, patience, and understanding the mathematics of money better than the crowd. Everything else is noise. Everything else is distraction. Everything else transfers wealth from the unaware to the informed. I'm 98 years old. I've lived through depressions, recessions, Inflation, deflation, wars, bubbles, panics, technological revolutions. One truth is constant. Wealth is created by avoiding destructive financial products, investing in productive assets, and letting compounding work for you over decades. The patterns never change. People lose money chasing safety, hype, and complexity. People build wealth quietly, methodically, and patiently. The secret isn't luck, it isn't genius. It's decisions repeated consistently, thinking in decades, not quarters, avoiding temptation, resisting social pressure, and focusing on fundamentals. That is the path to financial freedom. That is the path Daniel Ruth followed. That is the path anyone can follow if they understand the mathematics and psychology of money.